What is lots in Forex trading? As someone just starting to trade currencies, I know the Forex terminology can initially be confusing. So, step 1 is determining the correct lot size for your account balance and risk tolerance. Key takeaways. A standard lot refers to 100,000 units of the base currency in a Forex trade. The lot size determines your position size and pip value, impacting how much you could gain or lose in a trade. For example, if you trade a standard lot of USD JPY, a 1 pip change in price will result in a $10 gain or loss. The same 1 pip move in a mini lot would result in a $1 gain or loss. Choose a lot size that aligns with your account balance and risk management strategy. As a beginner, start with a micro or mini lot to get used to the market without taking too much risk. The dollar value of a lot, given the number of pips and particular currency pairs, is found quickly through the calculator in the article linked below. The formula to calculate the correct lot size is lot size equals account balance multiplied by risk percentage divided by the stop loss. Most Forex brokers allow you to trade nano, micro, mini and standard lots to suit traders of all experience levels. You can start small and work your way up as your knowledge and confidence increase. What is a lot in Forex trading? In Forex trading, a lot refers to a standardized unit of measurement used to determine a position's trade size and pip value. Again, the standard lot size is 100,000 units of the base currency. The base currency is the first one stated in a currency pair. For example, the base currency in the year, USD, is the euro. Types of lot sizes in Forex: standard, mini, micro and nano. The standard lot size in Forex is 100,000 units of the base currency. Thus, one standard lot for the EUR/USD currency pair would be 100,000 euros. The mini lot size is 10,000 units, 1/10 the size of a standard lot. Mini lots allow you to trade with less money but still experience the thrill of Forex trading. The micro lot size is 1,000 units, perfect for beginners with small accounts who want to trade Forex without risking too much capital. Nano lot sizes, 100 units, were introduced to make Forex trading accessible to retail traders with small accounts. Nano lots are 1/1000th the size of a standard lot, so you can open positions with as little as $1. Like and subscribe if you want us to keep making these videos. Thank you. As a beginner Forex trader, I started with micro and nano lot sizes to get familiar with the market without worrying about losing too much money. Now that I have more experience, I trade mini and standard lots. How to calculate pip value based on lot size. We need to first be aware of which is the quote and base currency. The base currency is the first currency in the pair and the quote is the second. For instance, in the case of EUR/USD, the euro is the base and the USD is the quote. As a Forex trader, one of the first things you must understand is calculating pip value based on your lot size. A pip is a fraction of the quote currency expressed as a decimal. The pip value refers to how much money is made or lost for each pip of movement in the currency pair you're trading. The formula for calculating a pip value is quite simple. You take the opening exchange rate of the currency pair, subtract the closing exchange rate, and multiply the difference by the lot size. Then, you multiply by the number of decimal places in the Forex pair price, usually 0.0001. Again, we need to know the quote and base currency. The base currency is the first currency in the pair, and the quote is the second. Here's an example, but all of this can be done quickly by a calculator located in the article listed below. A single pip for the EUR/USD is 0.0001 of your position size. To find the value per pip, multiply your position size by the value of a pip for your currency pair. One lot equals 100,000 euros. 100,000 euros multiplied by 0.0001 per pip equals 10 euros per pip. One mini lot equals 10,000 euros. 10,000 euros multiplied by 0.0001 per pip equals 1 euro per pip. One micro lot equals 1,000 euro. 1,000 euro multiplied by 0.0001 per pip equals 0.10 euros per pip. If you buy one standard lot, 100,000 units, of EUR/USD at 1.1800 and sell at 1.1900, the difference is 0.0100 or 100 pips. Multiply 0.0100 by 100,000 to get 1,000 euros in the base currency, in this case, euros. To find what it is worth in the base currency, multiply by the present rate of the currency pair, in this case, approximately 1.18. 1,000 times 1.18 equals 1180 USD approximately. Pip sizes differ between currency pairs. The pip size is 0.0001 for all currency pairs other than those that contain the Japanese yen as the quote currency. For currency pairs with the JPY as the quote currency at the end of the pair name, the pip size is 0.01. Choosing the right lot size based on trading account balance and risk tolerance. The lot size you choose depends on two main factors. Your account balance. The more money in your account, the more significant the lots you can trade while controlling risk. Use 1 to 3% of your balance to determine how much you can risk per trade. Your risk tolerance. If the thought of losing money keeps you up at night, stick with smaller lot sizes. More aggressive traders can handle the ups and downs of larger lots. But never risk more than you can afford to lose. You can also think about your lot size in terms of pip value. For example, if the EUR/USD moves 100 pips and you have a mini lot open, you make or lose €1 per pip, so €100 total. A micro lot would be 0.10 euros per pip, 100 pips then implies you lose €10. Ensure you understand how pip value relates to your lot size and trading strategies before trading live. Start small if you're new to trading Forex. You can always scale up your lot sizes as you gain experience. And be sure to practice trading with a demo account first to understand how lot sizes work before putting real money on the line. The Forex market may initially seem complex, but learning about concepts like lots will set you up for success.